Pretty extraordinary gyrations in the market, particularly on the long end, people selling bonds for the first time in a long time. What do you think this is about? Is this about the sort of tail risk of the recession being seemingly a little bit of those concerns receding?
I don't know. I mean, I think the bond market's still, priced for a pretty bad scenario, just maybe less bad than it was a few weeks ago. It's hard to know exactly. If anything, I'd argue that the last jobs number was a reason to be buying bonds. I thought at the margin it was a little bit weaker. Maybe part of what's going on here is that, I think overall in the main, the market is right about inflation, but we will have some inflation and, not no inflation. And so maybe that's why you've seen break-even rates come up a little bit. Obviously, real rates have come up a little bit, so maybe that's part of what's going on. We saw a little bit of a bid in crude recently, so maybe that's part of it. That was obviously before Bolton got fired today, so or whatever. So it's hard to know exactly.
Because Joe and I were having this debate this morning, and we seem to have spoken a lot about the bond buying that happened in the US being a global perspective, the fact that yields were negative everywhere else. Is there an element that we're seeing a sell-off in Europe sparking in the US? And I was wondering how much the ECB had to do with that if we're not going to get the QE that we expected.
Well, I mean, that's certainly possible. It's an interesting sort of thing going on in Europe. I mean, the appetite for aggressive easing seems to be there, but unfortunately Draghi's leaving soon. And, you have actually seen some relief rally in European banks. So, I think their appetite for this sort of negative interest rate policy is kind of coming to an end, and maybe that's going to, the thought would be that it provides some relief to the European banking system, which may be why European banks are doing better, and maybe that's why you're seeing some, life coming back into the U.S. yield curve as well.
So, Brian, when you look at kind of what's been happening in credit and sort of this sort of buying that we've been seeing, a lot of it has been basically in investment grade, and I'm supposed to believe that this is a positive sign. This because confidence in the market. If there's so much confidence, why aren't they buying like triple Bs and triple Cs?
Well, I mean, I think you saw what happened with Ford yesterday. Yeah. There's the risk of the downgrades, and there's the risk that the economy is going along okay, but maybe that's not enough for certain companies. You see others like WeWork today in the news, right? I mean, it's not a perfect economy for every company, regardless of what your business model is. There are some that are going to be floundering along, and especially as we get to late cycle, I think that investors have to start thinking about which are going to be the winners and losers, because so far everything's been a winner this year.
Those companies that issued last week at the investment grade, I mean, they nailed it.
Perfect.
Right? Like
timing.
That was like historical great timing.
Yeah, I mean, like you look at what's happening today, and I think the conversation that we were just having, you list maybe 5, 6, 7 reasons. It was one of the more orderly 10 basis point increases in 10-year yields that I can remember. It seemed like I would just be checking in every half hour, another basis point higher, half hour. I mean, into the close here, we're at 1.74% of 10-year. The 2-year yield has cracked its 50-day moving average. Those seemed so far away just a week ago, and all of a sudden now it's backed up, and it's a different borrowing environment.
So is it a good time to keep on borrowing? Neil, are you going to expect corporates to keep on cashing out, or are you expecting them to start worrying about recession on the horizon or worries about the US economy not being quite as healthy as it was before?
Well, I mean, I think in terms of borrowing, I think about the household sector, and banks have not really been passing on the big drop in interest rates to consumers. I think the recent backup in rates probably means that, I think one of the things you'll see is mortgage rates probably won't back up as much, even though 10-year rates have come up. So that mortgage spread that had blown out over the last few weeks will probably come in a little bit. So, that could be helpful. So that may keep the sort of momentum in, mortgage applications, refis, purchases, that may keep it going.
Where do you think this leaves the Fed? Because not long ago, we were talking about like 50 basis points. They got to really get ahead of the curve. Now it feels like, all right, maybe they can, you see the steepening of the 210s. Maybe the 3-month 10-year goes positive again. Does this give them a little more comfort that they don't have to use too much of their ammo up front?
So I think they probably should. So I'm of the view that they should be using their ammunition up front, because I think the more they do now, the less they'll have to do later. Right. That's my view. I was, I think, wrong now, but I was advocating for 50 basis points as recently as last week. Because, look, at the end of the day, Joe, they're going to cut 25 basis points next week. And then they're going to leave the door open to go another 25 the month after. So why not just do all 50 at once? I mean, what's the risk? Inflation's below...
Freaking everyone out?
Hopefully they're watching, because you make a lot of sense.
Well, I mean, to me, there's more downside to only going 25 now.
Right.
And there's modestly more upside to going 50. I would also just say, I mean, when you think about data dependence, so let's leave the bond market out of it for a moment. Look at the revisions to employment growth recently. On average, over the last 3 months, the revision between the last estimate and the first is minus 35,000. So the unemployment rate actually hasn't moved since last September. So you're basically talking about almost a year where the unemployment rate hasn't gone down. And I think one of the things that's sort of the two-handed labor market, right? I mean, the level of activity is still quite good. Wages are growing. Unemployment is low. People feel good about their job situation. They're quitting still. But the momentum is slowing. And if the momentum slows enough, then the level of activity stops improving. So I think the Fed needs to be cognizant of that. And as I say, it's one thing to be doing this when inflation's above 2%. But inflation's not above 2%.
But what's the effect of this, Brian? I mean, what's the effect on the market if they would go, I mean, just take his 50 basis point hypothetical. I mean, what would the effect be?
I mean, I think the point that it could freak people out is a fairly valid one. If the market's not pricing in 50, I don't see any reason why they would go 50, besides some sort of shock and awe. But I think it could backfire because people would sort of say, okay, what is the Fed seeing in the economy that we're not seeing? Is what happened in August justified? Are there real concerns on the horizon growth-wise? I think the point about unemployment being stable is actually a really interesting one, and one that one of my colleagues, Carl Smith, was writing about, the change in unemployment leading up to the election and how that could actually pose a risk for the president's re-election chances, which in turn could affect trade policy and all these sorts of other things.
Which the Fed isn't supposed to be concerned about,
well,
other than
of course
Dudley.
not.
Only if you're retired.